Joining me right now is MacroMavens President Stephanie Pomboy. Stephanie, great to see you. Thanks so much for being here. Give us your estimates and expectations for the second half of the year in terms of the macro story. And what are you expecting on inflation?
Well, thanks for having me. Happy Friday. So I guess, my expectations continue to be that this Fed tightening is working with a lag. And, as Kaplan describes the impact on the banking system as a dull headache, I would describe what I'm seeing in the corporate credit market more as a migraine. You're really starting to see the impact of the Fed's rate hikes work its way through there. In the first quarter, interest expense for S&P 500 companies was up 71% year on year to the highest level since 2008. That's not my number, that's S&P's number. So that's really starting to impact, and it's just starting now. So we'll expect to see that drag continue to feed through in the coming quarters. So my outlook is pretty much the same as when we spoke last, and that is that I expect these higher rate hikes that the Fed has already made to continue to dampen economic activity and to create real stress in the credit markets, the corporate credit market especially. And I think, we're just waiting to see when that's really going to impact the consumer. And on that score, there's a lot of detail that suggests the consumer isn't as strong as the headline numbers look. For example, overall consumer spending is up 5.6%. When you look at the discretionary portion of that, for example, retail sales is only growing 1.5% year on year. And actually, almost 50%, 48% of the growth in consumer spending over the last year has come from housing and healthcare. So that services inflation that Robert Kaplan talked about as being sticky and problematic is in the stuff that consumers have no choice but to spend money on, housing and healthcare. So that's probably not going to go away anytime soon. It's the impact.
And that's what he said, that he thinks that services inflation is the issue because you're seeing goods and the goods part of this economy weaker as a result of all of those rate hikes. We're still questioning when, in fact, we're going to see the full effect of now 11 rate hikes. Have you identified specific areas that are actually performing poorly as a result of those rate hikes, Stephanie? We talked about bankruptcies and the potential for debt rolling over in the past.
Yeah, well, I come back to the consumer and the consumer discretionary segment, because if you have to spend a lot of money, inflation on housing and healthcare and food and energy as consuming more of your budget, you have to cut back on all the discretionary stuff. And that's why you're seeing deflation in the goods segment. So not surprisingly, of the bankruptcies we've seen year to date, which is the largest number of bankruptcies since 2010, I might add, 24% of those have been in the consumer discretionary space. That's the largest single sector in terms of corporate bankruptcies. That's not surprising. And then on Monday, for example, we're waiting to see Yellow, the largest LTL shipping company, file for bankruptcy. They're expected to file on Monday. That'll put 30,000 employees out of work. They touch the consumer by shipping all the goods back and forth from warehouses to stores, et cetera. So it's all, in that area that I'm really focused on.
What about the cost of employment? We are waiting on the June core PCE number. That's going to come out in just a few seconds, 20 seconds. Expectations call for a gain of 0.2% month over month and 4.2% year over year. But there's also the employment cost index coming out, Stephanie. What are your expectations there? Is this a number that you're watching?
Yeah, absolutely. Number one, cost to business. So it's crucial, and it really figures pretty largely in my own outlook for corporate profits, which, as you know, Maria, has been a lot more negative than most of the street. I think Wall Street believes that the second quarter just ended was the bottom in profits, and that we're going to see growth ramp higher into the double digits next year. Nothing I look at suggests that. I mean, we're getting some easing of labor pressures, but then you see like the UPS settlement. And so it's, there are areas where wages are very sticky. And then there are some spaces where companies have a little more leeway. But until we get the supply of labor to increase dramatically, I don't know where you're going to see a real easing of wage pressures. And surprisingly, we're just not seeing that real increase in the supply of labor like we'd like to so far. So I think companies are going to continue to be under pressure. And then I look at my screen today and here's oil over $80 again. So that's not going to help either.
It's a great point on oil, the underlying issue with regard to inflation. All right.